everyone, I'm Ken Rolliger, head of content at JoinProp, and welcome to episode 22 of the JoinProp podcast. And with me, as always, is my co-host, Jessica.
Hi, I'm Jessica LaRusso, freelance podcaster, not a trader, here to ask all the questions Ken takes for granted.
Look, Jessica, I try not to take things for granted, but I guess sometimes I skip a few steps.
Ken, last week you literally dropped Gamma Squeeze into a sentence like it was a household cleaning product.
Okay, fair. Honestly, fair point, Jessica. I will do better today because, AI is everywhere right now, and prop trading is absolutely not immune to it.
Which is terrifying because my brain immediately goes to, like, Terminator scenarios, but in this case, the machines are they're taking over Wall Street.
Kind of, yeah.
Yeah.
But wait, let me back up. Before we get into the whole AI takeover thing, we should probably, clearly define what we're actually talking about when we say prop trading, because the baseline mechanics of the industry dictate why AI is so dominant in it.
Yes, please. What is the actual baseline definition? Because people throw prop trading around, but how is it actually different from, like, a bank or a hedge fund?
Right. So the simplest way to put it is proprietary trading involves firms trading financial instruments using their own capital.
Wait, their own capital? What does that actually mean in plain English? Like, the founders just pooled their personal savings accounts together.
I mean, sometimes it starts that way, but no, it's the firm's balance sheet. Like, if you look at a hedge fund, they are an agency business, technically. They go out, they pitch institutional investors, pension funds, wealthy individuals, and they gather all that outside money. They pool it, they trade it, and they take a management fee plus a cut of the profits.
Okay, so if a hedge fund blows up, it's the pension fund that loses the money.
Essentially, yes. The hedge fund loses its reputation and its fee revenue, but the actual capital destruction hits the clients. Prop trading is entirely different. There are no clients. Zero. They don't take outside money. They don't charge management fees. The firm is essentially trading its own corporate bank account.
So if they lose it all, they're just losing their own shirts.
Yes. They eat 100% of the losses. But the flip side is they keep 100% of the profits. They aren't sharing the upside with anyone outside the building. It's principal trading, not agency trading.
Okay, so it's a closed loop. They have a pile of cash, and their entire existence is just trying to make that specific pile of cash bigger without having to explain their strategy to outside investors.
That is the crucial part.
Right.
They don't have to explain themselves to clients, which means they can deploy capital into the most insanely complex, opaque strategies imaginable, as long as it works. And into this closed loop, this is where we are dropping artificial intelligence.
Artificial intelligence is doing a lot of heavy lifting in that sentence. Are we talking about, like, ChatGPT buying Apple stock?
No, not at all. We are talking about custom-built machine learning algorithms, deep neural networks, systems that ingest mathematical and textual data at a scale that breaks the human brain. And this is the real shift. They execute the trades with minimal human intervention.
Minimal human intervention. I don't like the sound of that. It sounds completely unsupervised.
Well, unsupervised learning is literally a branch of machine learning we're going to get into. But
oh, perfect. So the robots are just running wild.
to give you a sense of the scale, just how massive this takeover actually is right now. If you look at the major exchanges, algorithms drive over 70% of the daily trading volume.
70%. 70. I need a second.
Yeah, over 70%.
Wait, 2/3. More than 2/3 of every single thing happening on a major exchange is just robots talking to other robots.
Pretty much. Humans are a minority on the stock market. We're just the noise. The bulk of the actual liquidity, the constant buying and selling, it's all algorithmic.
Wait, that's literally their business model.
What do you mean?
Think about it. If a prop firm is just using its own money, it's a closed loop. And an AI, an algorithm, is the one actually analyzing the data and pulling the trigger with minimal human intervention, then the firm isn't a trading firm anymore. It's just an IT company holding a wallet.
Let me stop you there, because it's an extreme leap. They aren't just an IT company.
How are they not? If the machine is doing 70% of the work, what are the humans doing? Just getting coffee for the server racks?
Look, the thing is, it's not a set-it-and-forget-it magic box. You have to build the architecture. You have to clean the data. You have to define the risk parameters. The humans are doing the quantitative research to build the models. But yes, the actual execution, the physical act of interacting with the market order book, the machines are infinitely better at it.
Define better, because 70% volume just means they're doing a lot of things quickly. It doesn't mean they're actually making money. I can lose money really fast. That doesn't make me a good trader.
Oh, they are making money.
Right.
Let me give you a specific example from the research notes. There was a mid-sized proprietary trading desk in Chicago. Classic, discretionary, and semi-automated firm. They were doing okay. Then they decided to overhaul their workflow and integrate machine learning algorithms into their core strategy execution. Within 6 months, they reported a 34% increase in their Sharpe ratio.
Stop. What is a Sharpe ratio?
Oh, okay, so a Sharpe ratio is basically a metric we use to understand risk-adjusted returns.
Risk-adjusted returns is not plain English. You're hiding behind the jargon again.
Wait, let me back up. I need to explain the math here because it's the only way this makes sense. The Sharpe ratio is a formula. It's the expected return of an investment minus the risk-free rate divided by the standard deviation of the returns.
Okay, you just threw an equation at me. Break that down. What is a risk-free rate?
The risk-free rate is basically what you could earn if you just parked your money in something with zero risk, like a U.S. Treasury bond. Let's say T-bills are paying 5%. If your prop firm takes on a massive amount of market risk to only generate a 6% return, you really only generated 1% of excess return. You did all that work and took all that risk just to beat the safest asset on Earth by 1%.
Okay, that makes sense. So the numerator is just how much extra money did we make beyond the bare minimum. What was the denominator? Standard deviation.
Yes, standard deviation. It measures volatility. Think of it as the bumpiness of the ride.
Give me a real-world example of the bumpiness.
Okay, imagine 2 human traders at this Chicago desk. Trader A makes 20% profit by the end of the year. But to get there, his account swings wildly. One day he's up 10%, the next day he's down 15%, he's surviving margin calls, he's sweating bullets. His standard deviation, the variance of his daily returns, is massive.
So he's taking huge, dangerous swings.
Exactly. Now look at Trader B. He also makes exactly 20% profit by the end of the year. But he does it by taking thousands of tiny, highly probable trades. His account never drops more than 1% on any given day. It just steadily ticks upward. His standard deviation is tiny.
Because the ride was smooth.
Right. So if you plug them into the Sharpe ratio formula, they have the same profit in the top half of the equation, but Trader A is dividing by a huge standard deviation and Trader B is dividing by a tiny one. So Trader B's Sharpe ratio is mathematically much, much higher. He's generating way more profit per unit of risk.
Okay, I follow the math now. So when the Chicago desk lifted its Sharpe ratio by 34% using machine learning, it doesn't mean the algorithm magically made 34% more raw cash?
No. It means their trading became 34% more efficient. They either made the exact same amount of money, but drastically reduced their exposure to massive drawdowns, or they increased their profit without taking on any additional risk. The algorithm smoothed out the ride.
But how is a machine actually doing that? How does a piece of code beat a room full of experienced Chicago traders by 34% in pure efficiency? What is the actual operational edge?
It comes down to a few core operational pillars. The first one, and this is foundational, is information processing.
Like reading charts faster.
Way beyond charts. Think about the physical limitations of a human brain. If you're a human trader, you have maybe 4 monitors, you've got price charts on one, a Bloomberg terminal news feed on another, maybe you're listening to an earnings call in one ear. You can only process so many inputs linearly.
Right, you can't read 3 articles at once.
But an AI, it's ingesting parallel data streams. It is simultaneously analyzing tick-by-tick order book data, reading 10,000 news articles the literal millisecond they are published online, scanning social media sentiment across global platforms, and digesting obscure supply chain metrics from international shipping logs, all at the exact same moment, real time.
That actually freaks me out, the sheer volume. It's like trying to drink from a fire hose, but the machine is just absorbing the entire ocean instantly.
And it doesn't just absorb it. It calculates the statistical correlations across all those data sets in real time, which leads directly into the second pillar, which is execution speed, because having the information is useless if you can't act on it. And in modern prop trading, milliseconds matter. Actually, scratch that, microseconds.
Microseconds,
Yeah.
like millionths of a second.
Yes, millions. Let me explain how physically absurd this is. When news breaks, say, an unexpected interest rate hike, the AI digests the text, calculates the probability of how that impacts 50 different correlated assets, and sends the execution orders to the exchange. It does all of this before the light from the human trader's monitor has even reached the human trader's retina.
Wait, you're saying the trade is literally over before the human physically sees the headline?
Literally. The latencies are measured in microseconds. Firms spend hundreds of millions of dollars optimizing the physical distance of their servers.
Physical distance, I thought this was all in the cloud.
Oh, no, no, no. The cloud is way too slow for this. If you are doing algorithmic prop trading, you use something called co-location. You pay the exchange, like the CME in Aurora, Illinois, or the NASDAQ in New Jersey. You pay the massive fees to put your physical computer server in the exact same room as the exchange's matching engine.
Just so the wire connecting them is shorter.
Yes, because data travels through fiber optic cables at the speed of light, roughly. But the speed of light is a physical limit. If your server is in Manhattan and the exchange is in New Jersey, that geographic distance adds microseconds of latency. If the algorithm is co-located in the same room, your wire is only a few feet long. You beat the guy in Manhattan to the trade every single time.
That is insane. They are fighting over the length of a physical cable to squeeze out a millionth of a second.
They even build private microwave towers between Chicago and New York, because microwaves traveling through the air are slightly faster than light bouncing through the glass of a fiber optic cable. That's the level of speed we are talking about.
So it's completely impossible for a human to compete. The game is just structurally rigged at the physical layer.
It is. If you are sitting at home day trading manually based on breaking news, you are the liquidity for the algorithms. They already saw the news, bought the asset, rode the micro spike, and are selling it back to you right as your human finger clicks the buy button.
That is incredibly depressing. Why do humans even try?
Well, because humans operate on longer time frames usually. But for these prop firms, speed is life. But honestly, the processing volume and the microsecond speed aren't even the biggest advantages they talk about. The thing that really moves the Sharpe ratio is emotional neutrality,
Meaning the computer doesn't get sad when it loses money.
meaning it operates entirely without cognitive bias during execution. Think about human psychology. If a discretionary trader takes 3 massive losses in a row on a Tuesday morning, what happens to their brain chemistry?
They freak out, they get stressed, they probably double down to try and win it back quickly, which is always a disaster.
Right. It's called revenge trading. The cortisol spikes, their judgment completely clouds over, and they abandon the risk parameters. Or the opposite happens. They get so paralyzed by the pain of the loss that when the perfect mathematically sound setup appears an hour later, they freeze. They are too terrified to pull the trigger.
Yeah, I'd probably be the freezer, honestly.
The algorithm doesn't care. It doesn't feel fear. It doesn't feel FOMO when a meme stock is rocketing to the moon. It doesn't panic sell at 2 a.m. because the Asian markets dropped 4% and it got scared. It just recalculates the probability matrix and executes the math.
Okay, I have a massive problem with this. I completely disagree with the premise.
With what? That machines don't have emotions?
No, with the whole concept of emotional neutrality. Because humans write the code.
Well, yes, the developers build the framework, but
Yeah. No, listen. If a human writes the algorithm, the human is setting the parameters. The human decides what the algorithm considers a good metric and a bad metric. The code must inherit the biases of its creator. You can't just wave a magic wand and separate the developer from the math. If the quantitative researcher has an inherent unconscious bias toward momentum trading over value investing, the AI is going to reflect that bias. It's not neutral, it's just a faster version of the human's bias.
I hear that, but you're conflating two different things. You're conflating the design layer with the execution layer.
How are they different? The design dictates the execution.
Yes, the human designs the framework, but the point of machine learning is that the AI discovers pathways the human never programmed. And more importantly, at the moment of execution, when the market is crashing, volatility is at 80 and everyone on the floor is screaming, the human developer's past bias doesn't matter because the machine is not experiencing an endocrine response. It does not sweat. It doesn't abandon its rules because it got scared. That's what emotional neutrality means. It adheres to the logic when humans structurally cannot.
I still think calling it neutral is dangerous marketing. The foundational logic is flawed because humans are flawed. But I will concede the point on the cortisol spike. I know I make terrible decisions when I'm stressed, and my laptop does not, so I get the execution consistency argument.
It's pure discipline.
Yeah.
And because of these compounding advantages, the data ingestion, the microwave tower speed, the absolute discipline in execution, the structural disadvantage for prop firms that don't have AI is becoming insurmountable.
It sounds like it. It's bringing a knife to a gunfight.
It's bringing an abacus to a supercomputer fight. Firms relying purely on human discretion are getting picked apart in the order books. Historically, this kind of tech deep learning, massive data infrastructure, it used to be the exclusive domain of the giant billion-dollar quantitative hedge funds.
Right, the guys who can afford to lay their own fiber optic cables across the ocean.
Exactly. But computing power has gotten exponentially cheaper. Cloud infrastructure for training the models is accessible. Open source machine learning libraries are everywhere. So now, this technology is bleeding down into the mid-sized prop firms. It's no longer a luxury, it's a life or death requirement. If you aren't automating your edge, the market will eventually strip it from you.
Okay, so you keep throwing around these terms. Machine learning, deep neural networks, algorithms. I hate buzzwords because usually people use them to hide the fact that they don't actually know how the underlying mechanics work. So let's actually look under the hood. What does machine learning practically mean in this specific prop trading context? Unpack the black box.
Fair challenge. Let's break down the actual technological stack these firms are running. When we talk about machine learning and quantitative finance, we're broadly breaking it down into three distinct methodologies.
Go, teach me the math.
The first one is supervised learning.
Supervised, meaning there's a quant sitting there watching it trade.
No, it's not physical supervision. It refers to how the training data is structured. It means the data is labeled.
Labeled how?
Okay, let's step away from trading for a second. If I want to teach a basic algorithm to predict house prices, I feed it a spreadsheet of 10,000 historical house sales. I give it the input square footage, number of bathrooms, zip code, and crucially, I give it the final actual sale price, the answer.
So you're giving it the inputs and the output.
Yes, that's the supervision. The algorithm's job is not to guess the price. The algorithm's job is to look at the inputs, look at the output, and mathematically map the relationship between them. It uses something called gradient descent, basically calculating its own error rate and tweaking its internal math until the error is as close to zero as possible.
Okay, so it reverse engineers the formula. How does a prop firm use that?
In trading, they use it for price prediction and classification. A firm will take millions of historical market scenarios. They feed the AI, the order book depth, the moving averages, the volume, and they label it with what happened 5 minutes later: price went up 2% or price dropped 1%. The model uses supervised learning to map the mathematical relationship between the setup and the result.
So it's basically memorizing historical cause and effect, like giving a student 10 years of past exam papers with the answer key attached.
That's a perfect analogy. It studies the answer key until it learns the underlying rules of the test. So that's supervised learning. The second methodology is unsupervised learning.
Let me guess. We burn the answer key.
We don't just burn it, it never existed. In unsupervised learning, the data has no labels, no outputs. You just take a massive, raw, chaotic mountain of market data and dump it into the algorithm. You don't tell it what to look for, you just say, find the structure.
What is the point of that? If it doesn't know what it's trying to predict, what is it actually doing?
It's clustering. It's finding hidden regimes and geometries in the data that human brains physically cannot perceive. Human brains evolved to understand 3 dimensions. We see simple, linear cause and effect. This thing happened, therefore that thing happened.
Right, narrative logic.
But unsupervised algorithms use math, like principal component analysis, PCA, or k-means clustering. They can map data points in a 30-dimensional vector space. They find relationships where 50 different obscure variables align in a hyper-specific way that precedes a market shift.
I can't picture 30 dimensions. Give me an example of what a hidden pattern actually looks like to the machine.
Okay, let's think. A human pattern is simple. A hurricane hits the Gulf of Mexico, oil refineries shut down, crude oil prices spike. 1 to 1.
Makes sense.
But an unsupervised clustering algorithm might churn through 20 years of global data and find a completely non-linear cluster. It might find that when copper prices in Shanghai drop by exactly 1.4% on a Tuesday, while simultaneously the shipping freight rates in the Mediterranean spike and the Japanese yen volatility index compresses, then, exactly 72 hours later, mid-cap agricultural stocks in the U.S. drop by 4%.
Why would copper in China and boats in the Mediterranean affect U.S. corn stocks? That makes no logical sense.
We don't know. That is the entire point. The algorithm does not know why it happens, and the human quants do not know why it happens. There is no narrative. But the unsupervised learning algorithm clustered the data and said, I don't care about the story. Mathematically, the geometry of this 30-dimensional data cluster indicates an 82% probability of this specific outcome.
That is wild. It's just pure brute force statistical geometry without any underlying why.
Right. Humans desperately need a story to feel safe. Markets don't. Unsupervised learning abandons the story to find the math.
Okay, that's deeply unsettling but fascinating. What is the third type?
The third one is reinforcement learning, and this is the one that feels the most sci-fi.
Hit me. How does this one work?
The best analogy is training an AI to play a video game. Imagine you drop an algorithm into Super Mario. You don't tell it the rules. You don't tell it how to jump. You just give it a reward function. You say, your goal is to maximize your score. Moving right gets a point. Falling in a hole loses a point.
So it just runs to the right, falls in the first hole, dies, and starts over.
Exactly. It uses trial and error. It explores the environment. The first 10,000 times, it just dies instantly. But slowly, it updates its policy. It learns that pressing A makes it jump over the hole. It optimizes its behavior purely based on maximizing the reward.
Okay, but the stock market isn't a Nintendo game. How do prop firms use that?
They build incredibly complex, simulated market environments. They map the historical order books, the slippage, the transaction costs. Then they drop the reinforcement learning agent into the simulation and define the reward function. They say, your goal is to maximize the Sharpe ratio. Go.
And it just plays the market millions of times.
Yes. It runs millions of simulated trading days. It tries a strategy, blows up the account, gets a negative reward, and tweaks its internal policy. By the time it's done, it has played the market through more scenarios than a human trader could experience in 10 lifetimes. And it has optimized a strategy that the human never would have thought of.
Okay, so you have supervised learning memorizing the past, unsupervised finding invisible geometry, and reinforcement playing a billion simulations. But earlier, you specifically mentioned AI reading news articles and earnings calls. Math equations can't read English. How is a clustering algorithm listening to a CEO on an earnings call?
That requires a totally different branch of the tech stack called natural language processing, or NLP, and specifically large language models built on transformer architectures.
I've heard of NLP, but isn't it just word counting, like scanning the transcript for the word bankruptcy and selling the stock?
It used to be. 10 years ago, NLP was basically a dictionary lookup. If the document had more negative words than positive words, it sold. But modern NLP uses self-attention mechanisms. It doesn't just read words, it reads context. It mathematically maps the distance between words in a high-dimensional space.
Explain what you mean by mapping distance.
If a CEO on a call says, we are experiencing some temporary headwinds, but our core revenue drivers remain incredibly robust, a simple word counter might get confused by headwinds. But a transformer model understands the semantic weight of temporary modifying headwinds and incredibly robust anchoring the conclusion. It parses the actual sentiment. It can even detect hesitation or hedging in the sentence structure.
Okay, but think about the logical conclusion of that. If every prop firm on Wall Street buys these advanced NLP tools, and they're all plugged into the exact same Bloomberg feeds and the exact same SEC filings, doesn't that just create a massive robot echo chamber?
What do you mean by echo chamber?
I mean, if all the machines read the exact same headline at the exact same microsecond, and they all run their fancy transformer math, and they all decide it's a negative sentiment, don't they all simultaneously dump the stock? Isn't that exactly how we get massive flash crashes? You aren't building a smarter market. You're just building an automated herd that stamps off a cliff at the speed of light.
I mean, that is a very real, documented systemic risk. You just described a liquidity cascade. When the algorithms all align on the same side of the trade, the buyers just vanish and the price drops to zero in a microsecond. But that vulnerability is exactly why the top firms combine their NLP with deep learning neural networks.
I need you to explain how another layer of math fixes the herd problem.
Because the deep learning network is designed to model nonlinear chaos. A basic firm's NLP says, bad news, sell immediately. But a top-tier firm's deep learning network ingests that same news, but it also looks at the order book depth, the current volatility regime, and the historical behavior of other algorithms in the specific scenario.
Wait, it's looking at the other bots?
Yes. The neural network realizes, okay, this headline is bad, but it's not that bad. However, I know the simpler NLP bots are going to overreact and dump the stock, creating an artificial price collapse. Therefore, my optimal strategy is to wait 4 microseconds, let them crash the price, and aggressively buy the dip they just created.
That is diabolical. The advanced robots are literally preying on the simpler robots. They are front-running the herd.
Exactly. It's predator and prey at the algorithmic level. The complexity is just compounding on itself.
It's exhausting to even try and conceptualize. But honestly, hearing you describe all this compounding complexity, it sounds incredibly fragile, like a massive house of cards. These mathematical models are so dense with so many layers of invisible geometry, they have to fail, right? They cannot be perfect in the real world.
No, they are absolutely not perfect. Which brings us to the fatal flaws of algorithmic prop trading. And the single biggest nightmare that keeps quantitative researchers awake at night is a mathematical trap called overfitting.
Overfitting? What does that mean?
Overfitting is what happens when a model becomes too perfectly tailored to its historical training data, to the point that it completely loses its ability to generalize to new, live data.
I don't follow. If it learned the history perfectly, shouldn't it trade perfectly?
Let me use an analogy. Imagine you have a graph with 10 dots on it, representing market prices over time. They generally trend upwards, but it's a little bumpy. If you draw a simple straight line through the middle of the dots, that's a robust model. It doesn't touch every single dot perfectly. It misses the noise, but it captures the overarching upward trend.
Right, a trend line.
Now imagine you unleash a massive billion-parameter deep learning network on those same 10 dots. It doesn't draw a straight line. It draws a wildly squiggly, chaotic curve that loops and bends to mathematically intersect with the dead center of every single one of those 10 dots.
So it has zero error. It perfectly mapped the past.
Yes. In the backtest, it looks flawless. The researchers look at the simulation and think they've built a money printer. But here's the problem. That squiggly line didn't learn the underlying market trend. It memorized the random, chaotic noise of the past. So when tomorrow happens, and dot number 11 appears on the graph, the simple straight line is probably pretty close to it. But the overfitted squiggly line is pointing off into deep space in the completely wrong direction.
Because the exact sequence of past noise never repeats itself perfectly.
Exactly. The live market is a living, breathing, chaotic system. An overfitted model is sitting there desperately waiting for the exact 2018 market conditions to replicate themselves down to the microsecond. When they don't, the model's logic shatters and it hemorrhages capital.
Honestly, that feels like a scam.
It's not a scam.
I'm not saying it's legally fraud. I'm saying conceptually it feels like a scam. You're just memorizing the answer key. If I take a history test and I just memorize the pattern of the bubble sheet A, C, D, B, I didn't learn history. I learned the test format. These prop firms are spending millions of dollars on supercomputers just to scam themselves with their own shiny backtests.
You know, a lot of veteran quants would actually agree with you. It is the ultimate illusion of perfect data. Firms allocate massive amounts of real capital to these overfitted models because the simulated equity curve looked like a hockey stick. And then the live market just eats them alive because the machine mistook random static for a signal.
So how do you fix it? How do you prevent the machine from memorizing the noise?
You essentially have to force the AI to be slightly dumber.
What? You spend millions on a supercomputer to make it dumb.
It's called regularization. It's a mathematical penalty built into the training phase. You punish the algorithm for being too complex. You force it to drop certain variables. You restrict the depth of the neural network. You artificially constrain it so it physically cannot draw the squiggly line. It is forced to learn the generalized rule instead of memorizing the exact data points.
I still love the irony of that.
Right.
We built a brain so powerful it tricked us, so we had to give it a lobotomy so it wouldn't blow up the firm's bank account.
That is genuinely how model tuning works. But the prop firms aren't the only ones terrified of these overfitted blowups. The regulators are watching this happen and they are panicking.
Oh, I can only imagine. If I'm sitting at the SEC and I realize 70% of the volume is controlled by unsupervised 30-dimensional math that the creators themselves have to lobotomize, I am terrified.
Terrified is the exact word, because it's a massive systemic risk. If an overfitted model goes rogue, or if it triggers one of those algorithmic herd cascades we talked about, it can wipe out billions of dollars of market value in minutes. So regulators are stepping in. In Europe, you have frameworks like MiFID II. In the US, there have been pushes like Regulation AT.
What do those regulations actually do? Do they ban the algorithm?
No, they can't ban them. But they demand transparency. They require firms to tag their algorithmic trades, and more intensely, they want the ability to inspect the algorithm's logic. If a bot manipulates the market, the regulator wants the firm to open the hood and explain exactly why the machine made that trade.
Wait, stop. We just spent 20 minutes establishing that these are deep learning neural networks and unsupervised clustering models. There is no line of code that says, if Apple drops, sell.
Correct.
The math is literally billions of decimal weights inside a matrix.
Yep.
You can't hand a spreadsheet of a billion random numbers to an SEC lawyer and say, here's the logic, it's a black box.
Yes.
So if a regulator knocks on the door and says, explain why your algorithm just dumped 1 million shares of crude oil at 2 p.m., the prop firm literally has to say, we don't know, the geometry told it to.
Essentially, yes. And you can imagine how well that answer goes over with federal regulators.
That is wild. How do you regulate a black box? It's physically impossible. You can't subpoena a math equation.
It is the single biggest friction point in quantitative finance right now. Firms are terrified that if they can't explain the models, regulators will just shut them down or impose such draconian restrictions that their technological edge is neutralized.
So what is the solution? If the AI's logic is fundamentally too complex for a human brain to read, how do you explain it to a government compliance officer?
This actually leads directly into where the frontier of the industry is heading right now. The solutions are almost as complex as the problem. The first major initiative is an entire subfield called explainable AI, or XAI.
Explainable AI, meaning forcing the machine to show its work.
Exactly. Explainable AI is essentially a secondary layer of algorithms designed to watch the primary trading algorithm and reverse engineer its decisions into human-readable proxy models.
How does that work mechanically?
They use techniques like SHAP values, which comes from cooperative game theory, or LIME. Basically, when the black box AI makes a decision to buy copper, the explainable AI rapidly perturbs the inputs. It tweaks the data slightly over and over to see which specific variables cause the biggest change in the output.
So it isolates the trigger.
Right. It isolates the most heavily weighted inputs for that specific micro decision, and it spits out a narrative. The model executed this trade primarily because Mediterranean shipping volume dropped 12% and the volatility index crossed this threshold. It creates a localized, linear explanation for a nonlinear decision.
Does it actually work? Or is the secondary AI just hallucinating a rational excuse that sounds good to keep the SEC lawyers happy, while the real decision was made in some incomprehensible 50-dimensional space?
That is the multi-million-dollar debate in the quant community. Skeptics argue exactly what you just said, that XAI is just a PR tool, an illusion of transparency that approximates the math without actually explaining it. But firms are pouring capital into it because they absolutely need a shield against regulatory audits.
It's just robots translating for robots to lie to humans. I love it. Okay, what else is on the frontier?
The next major shift mentioned in the research is something called federated learning.
Federated, like a federation.
Yes. It's a method for collaborative model training without actually sharing any sensitive or proprietary data.
You lost me immediately. Collaborative. Prop firms are paranoid, cutthroat silos. They hide their microwave cables. Why on earth would they collaborate?
Because they're hitting a wall. Machine learning models are inherently hungry. They scale with data. But no single prop firm, not even the biggest ones, has all the data in the world. They only have their own historical trades and their own localized order book captures. To build a truly omniscient model, you need more data than any one entity possesses.
Okay, so they want to team up. But how do you team up without showing the other guy your secret sauce? If you don't share the data, what are you sharing?
It's brilliant mathematically. Instead of bringing the data to the algorithm, you bring the algorithm to the data.
Explain that.
Okay, let's say Firm A in Chicago and Firm B in London want to collaborate. They both have a copy of the exact same blank neural network. Firm A trains the network on its highly secretive Chicago data. The network learns, and it calculates a massive matrix of mathematical adjustments, gradient updates.
Okay, so it updates its math.
Firm A does not send its Chicago data to London. It only sends that matrix of mathematical adjustments to a central server. Meanwhile, Firm B in London trains its network on its secret data and sends its mathematical adjustments to the central server. The central server averages those two math updates together and sends a new, upgraded global model back to both firms.
Oh, so the model learns from the London data, but the Chicago guys never actually see the London data. They just get a smarter robot.
Exactly. The model travels, but the raw data stays local behind the firewalls. It allows the entire industry, or consortiums of firms, to build massively intelligent generalized models while maintaining absolute privacy over their proprietary trading logs.
I am highly skeptical. I feel like some genius quant in Chicago is going to figure out how to take those mathematical adjustments and reverse engineer them to figure out exactly what London is trading.
That is called a model inversion attack, and it is exactly why they have to use homomorphic encryption on the updates. It's incredibly difficult to secure, and the computational overhead is massive, which is why it's still experimental in finance. But if they crack it, it changes the entire data landscape.
Okay, so we have explainable AI faking explanations and federated learning building secret megabrains. Is there anything else?
The final piece of the sci-fi tech stack, the ultimate endgame they're all racing toward, is quantum computing.
Oh boy, here we go. Teleportation and alternate dimensions. Please keep this grounded.
I will try. but it inherently breaks physics as we know it. Standard computers, even the massive supercomputers these prop firms use, run on bits, ones and zeros, binary logic. You process a calculation sequentially, A, then B, then C.
Right, standard computing.
Quantum computers use qubits. Because of a physical property called superposition, a qubit isn't just a 1 or a 0. It can exist as both simultaneously.
Ken, pull it back to Earth. What does a spinning quantum coin actually do for a prop trader trying to make a profit?
It solves the optimization bottleneck. In quantitative finance, firms face massive optimization problems, like portfolio balancing. Imagine a prop firm has 5,000 different assets. They want to find the exact percentage allocation of each asset that maximizes returns, minimizes risk, accounts for transaction costs, and balances liquidity constraints perfectly.
Okay, a big math problem.
It's an unfathomably big math problem. It's basically the traveling salesman problem on steroids. For a classical supercomputer to find the absolutely perfect, mathematically optimal combination out of millions of assets, it literally has to calculate the combinations one by one. It could take a supercomputer thousands of years to find the perfect answer.
But the market changes in microseconds. A calculation that takes a year is useless, so they just settle for good enough.
Exactly. They use heuristics to guess a good enough answer. But a quantum computer, because its qubits exist in superposition, it doesn't test the combinations one by one. Through a process called quantum annealing, it maps the trading problem to an energy landscape. The qubits naturally collapse into the lowest physical energy state, which mathematically corresponds to the absolute optimal portfolio balance.
Wait, it just collapses into the right answer.
Yes, it essentially tests every single combination simultaneously and settles on the perfect optimization in 3 seconds. A problem that takes a classical computer 10,000 years is solved instantly.
That completely breaks my brain. If a prop firm gets a stable quantum computer attached to their trading desk, they just win capitalism, right? They just optimally extract all the money from the market.
Pretty much. Whoever scales quantum finance first will have an unbridgeable God-tier advantage. They will see the mathematically perfect trade while everyone else is still booting up their classical servers. But we are still years away. The hardware is incredibly unstable. A change in room temperature, a stray cosmic ray, can cause the qubits to lose coherence and ruin the calculation.
Well, that's a relief. Let the robots worry about room temperature for a decade before they take all our money.
But, despite all this borderline sci-fi technology we just talked about, the quantum states, the federated networks, the deep learning, the source material actually ends on a surprisingly grounded note. I want to read the exact conclusion from the research here.
Let's hear it.
It says, the most successful prop trading firms will be those that strike the optimal balance between technological sophistication and trading wisdom.
Trading wisdom. That is a very romantic, squishy phrase for an industry entirely run by 30-dimensional math and microwave towers. What does wisdom actually mean when 70% of the volume is bots front-running other bots?
It means the human element isn't dead. It's just shifting up the value chain. Pure, discretionary human execution is dead. But human judgment is still the absolute safety net.
For what, exactly? We already established the AI processes 1,000,000 times more data and doesn't panic at 2 a.m. Why do we need the human?
Strategy generation, for one. An AI is an optimization engine. It can play the game perfectly, but a human has to invent the game. The human decides what new alternative datasets to buy, what the firm's macro risk appetite is. But more importantly, humans are required for unprecedented market conditions, the true black swan events.
Because of the overfitting problem, the AI only knows the past.
Exactly. Financial time series data is non-stationary. The rules of the market literally change over time. If a global pandemic hits and entire global supply chains freeze in a way that has never been recorded in the history of digitized financial data, the AI is blind.
It has no historical geometry to reference.
None. Its neural network is useless because the past no longer predicts the future. In those specific moments of absolute structural breakdown, when the quantitative math shatters, you need a human trader with actual wisdom, someone who understands human psychology, geopolitics, and plain old common sense. You need a human to reach over, manually override the system, and pull the plug before the confused AI trades the firm into bankruptcy.
So the human's ultimate job is basically to be the adult in the room when the supercomputer throws a tantrum because it doesn't understand the new rules of the world.
Honestly, yeah, that is the optimal balance. The AI handles the microseconds, the human handles the macro reality.
Man, We have covered an insane amount of ground today. I'm trying to figure out what my actual takeaway is here, because it's definitely not a neat bullet point list.
No, it's a messy, complex landscape. What's sticking with you the most out of all this?
I'm still hung up on that 70% volume stat, just the sheer physical scale of the automated takeover. But honestly, the overfitting thing, the scam aspect of it, is what's really going to keep me up. The idea that these brilliant firms are pouring millions of dollars into supercomputers, thinking they've built a crystal ball, and it turns out they just built a really expensive math parrot that memorized the past noise. That illusion of perfect data, it's a massive blind spot in the smartest industry on Earth.
I think for me, it's that final conclusion. The fact that human wisdom is still the ultimate safety net. We get so completely caught up in the processing speed, the microwave towers, the quantum qubits. But at the end of the day, when the market does something completely insane and unprecedented, the smartest machine in the world is still just looking up at a human to tell it what to do.
Until the AI learns how to predict the insane things too.
Well, let's hope that's a few years out. Speaking of things being out, that's all the time we have for this deep dive. But if you thought today was wild, wait until next week.
Oh, what's episode 23?
We are going to talk about what happens when everyday retail traders, regular people tapping on their phones, try to actually compete in the order books against these billion-dollar institutional bots. It gets incredibly messy.
I'm already stressed out just thinking about it.
It's going to be a good one. Thanks for hanging out with us, everyone. I'm Ken Rollinger.
And I'm Jessica LaRusso. Catch you next time.